people earning $300,000 a year who would be in financial trouble within 4 months if their income stopped. And there are people earning a third of that amount who could comfortably go several years without working at all. That inversion isn't rare, it's everywhere, and it exposes something fundamental about the relationship between income and wealth. A relationship most people assume is linear, but is in practice barely correlated at all. This is worth understanding clearly, because the instinct to solve every financial problem by earning more is one of the most expensive blind spots a professional can carry. The default financial plan for most ambitious people looks something like this. Earn more, then earn more again. Keep pushing income upward, and eventually the money will stack high enough to create safety, freedom, options. The logic feels airtight. If the problem is not having enough, the solution must be getting more. And so the entire professional trajectory gets organized around income acceleration. Early career, you take the job that pays best. Mid-career, you negotiate harder, switch companies, add credentials. By your late 30s or early 40s, you perhaps doubled or tripled your starting salary. Real progress, by any conventional measure, in many developed economies, the US, UK, Canada, Australia, a professional household earning between $150,000 and $300,000 sits comfortably in the upper tier of income distribution. These are people who, by every external signal, have succeeded financially. But here's what makes this worth examining. Income, no matter how high, shares a single structural characteristic with minimum wage. It stops the moment you do. Whether you earn $50,000 or $500,000, earned income is fundamentally a transaction. You provide labor, expertise, or time, and in return you receive payment. That payment is not wealth, it's revenue. And the difference between those two concepts is not semantic. It's the difference between a flowing river and a reservoir. One exists only while the source keeps running. The other holds water regardless. Let's look at why earning more on its own so often fails to build what people expect it to build. Consider a professional whose income has grown from $80,000 to $200,000 over a 12-year career. Impressive trajectory. Generally speaking, after taxes, which in most developed countries scale progressively with income, that $200,000 delivers somewhere around $130,000 to $150,000 in actual take-home pay. The exact figure shifts depending on jurisdiction and circumstances, but the principle holds. Higher income meets higher marginal tax rates. Now here's where the structural problem compounds. Income growth almost never occurs in isolation. It arrives inside a context. A higher paying role typically means a higher cost city. A more demanding position often comes with expenses that feel less like luxuries and more like operational requirements. The appropriate neighborhood, the reliable vehicle, the wardrobe that matches the room you're now sitting in. Childcare in a professional urban household can easily run $15,000 to $30,000 a year across these economies. None of these are reckless choices. They're environmental responses, but they function as a ratchet, easy to move in one direction, nearly impossible to reverse. So that professional who climbed from $80,000 to $200,000, their spending likely climbed from $60,000 to $150,000 over the same period. The income more than doubled. The margin between income and spending may have barely moved. This is the arithmetic that most people never confront directly, because the numbers on the surface, the salary, the title, the tax return, all suggest forward motion, but the distance between current income and current spending is the only number that actually creates wealth. And for many high earners, that distance remains stubbornly narrow. There's a second structural issue, and it's more subtle. Earned income is linear. You can optimize it, negotiate it, grow it, but it scales with your time and your presence. There are only so many hours. There's only one of you, which means earned income has a natural ceiling determined by the market value of your skills multiplied by the time you can sustain delivering them. Assets behave differently. Once acquired, they operate on a compounding curve rather than a linear one. They don't require your presence on Monday morning. They don't reset when you get sick or take a leave. They accumulate value or generate returns across time horizons that extend well beyond any individual workday. This isn't an argument against earning well. Higher income provides more raw material, and raw material matters. but raw material that passes through your hands without being converted into durable assets is just throughput, high-velocity cash flow that creates a sensation of wealth without the structure of it. And that's a distinction with real consequences. Here's where this becomes more than a math problem. High income creates a very specific psychological condition. It generates a feeling of security that is disproportionate to the actual security it provides. When a large deposit hits your account every 2 weeks, the nervous system registers safety. Bills are covered. Lifestyle is maintained. The immediate future feels handled. But that feeling is contingent. It depends entirely on the next deposit, and the one after that. Strip away the income through a layoff, a health event, an industry contraction, burnout, and the security disappears almost instantly. What remains is whatever was built underneath the income. For many high earners, that foundation is shockingly thin relative to the life constructed on top of it. This is the paradox embedded in the title. The person who earns more feels more secure, but unless they've been deliberately building outside of their income, they're not more secure. They're more dependent. Their financial survival is entirely tethered to a single mechanism, their ability to keep earning at or near their current level. That's not independence, that's exposure, and there's a psychological cost to this that rarely gets named. Somewhere beneath the surface, many high-earning professionals sense this fragility. They feel the pressure not just to perform, but to never stop performing. The career can't plateau, the income can't dip, because the entire structure requires continuous fuel. That quiet pressure, the one that makes the idea of slowing down feel genuinely threatening, is not a sign of ambition. It's a symptom of structural dependency. The income became the architecture instead of the building material. What makes this particularly difficult to see is that the external markers all point the other way. The lifestyle looks like success. The income confirms it, and the culture around high earners reinforces the narrative constantly. But the internal experience, that persistent sense that you can't afford to stop, tells the real story. So how do you think about this differently without discarding everything you've built? Start by separating 2 questions that most people unconsciously merge into one. The first question is, how do I earn well? That's a career question. It involves skills, positioning, negotiation, market value. It's important, and most professionals are already reasonably focused on it. The second question is, what am I building with what I earn? That's a structural question, and it operates on an entirely different logic. Earning is about maximizing input. Building is about what survives after the input stops. The people who eventually reach financial independence, genuine independence, where work becomes a choice rather than a requirement, generally aren't the ones who earn the most across their careers. They're the ones who treated income as a temporary condition and used the window it provided to construct something permanent. That might mean accumulating assets that generate returns independently. It might mean building equity in a business. It might mean simply maintaining a disciplined gap between earnings and spending and allowing that gap to compound quietly over 15 or 20 years. The specific approach varies. The underlying principle doesn't. Income is a window. It opens when you're working and closes when you stop. The question isn't how wide the window is. It's what you move through it while it's open. And the uncomfortable truth is that most people spend their highest earning years making the window look impressive, rather than using it to move assets to the other side. Here's what this comes down to. Earning more will not save you. It never could. Not because income doesn't matter, it does, but because income, by its nature, is borrowed time. It exists only while conditions hold, while your health holds, while the market holds, while your capacity to show up and deliver holds. Wealth is what remains when those conditions change, and they always eventually change. The real question was never how much you can earn. It was always how much of what you've earned will still be there when you're done.